Think insurance is boring? Think again. Many experts say that insurance is the most powerful industry on the planet. So join us and discover why the Quoters Cast is making insurance super cool. Today, my guest is Ed Mathews, who is the founder and CEO of, of clarkst Capital, which is a real estate investment club. And you can find them online at clarkst.com. Ed is a real estate investor himself, who is also a tech startup angel investor. And he also is the host of his own podcast called Real Estate Underground. So I'm happy to welcome Ed Mathews to the Quoters Cast. Hey,
thanks,
Ed.
Renee. Thanks. Good to see you.
Likewise. So let's start. Let's start, first of all, you have a real estate investment club. So maybe you can give us some background on how you've arrived at this point.
So just a little clarification. So it's a real estate investment company.
Okay.
And so we buy, informally, we buy crappy apartment buildings from landlords who aren't very good at their jobs. Okay. And then we make those buildings clean and safe and upgrade them and make them where people are proud to live there, and hopefully they stay for a long time. And we get to build a profitable business with each building we buy. Okay,
excellent. How long have you been doing that?
Let's see. So my first property we bought in February of 2011. Okay. So 12, almost 13 years.
All right.
Seems longer, but that's about it.
Well, yeah, I mean, with ups and downs, like it's been over the last decade or so. And where exactly are you
Indeed.
Located? Yeah, I know you're on.
So we're based at.
Sorry.
Yeah, I'm in Connecticut.
Okay. All right. Okay. So how does someone go about signing up for your group? Because I've looked at these before, and it's a little tricky, and I know there's minimums and all that. So if I landed on your site, how would I go about signing up for your club?
I dislike this answer, but it's reality, and the answer is it depends. So if they are an accredited investor and we have a project, they can invest in any project we have or a fund or anything like that. If they are not accredited, and I'll define that in a moment. If they're not accredited, then they may be able to participate in some of our projects. So there are primarily two types of real estate syndication type projects that the SEC, the Securities Exchange Commission, pays attention to. And the first is 506B reg. And so that one allows accredited and what are called sophisticated investors to invest. And we can have up to, I believe it's 35 non-accredited sophisticated investors. So an accredited investor, there's a lot of criteria, but the primary ones are either an individual or a couple who has $1 million in net worth, an individual who makes $200,000 a year for the previous 2 years and has the expectation they're going to make it again this year, and a couple whose combined income is $300,000 again for the last 2 years, and also with the expectation that they're going to do the same this year. Okay.
All right.
And so the logic there is, just to break it down, the logic is there that the SEC is counting on the fact that if you make a lot of money or you're worth a lot of money, you have the level of sophistication to be able to, and experience to be able to evaluate whether or not a real estate deal like the ones we work on is a good deal for you, right?
Okay,
which
well,
is mostly.
Okay, I just want to jump in there because the qualifications seem to be about income. Yet I do know there's a lot of people who make that who are not that sophisticated with financial products and with real estate.
You're looking at them.
Yeah. So when somebody comes to you like that and they're qualified to be accredited, yet you can tell they're not necessarily sophisticated, how do you go about dealing with a client like that?
So it'll be one of a couple of things. One, they just may flat out not be a good fit for us. And so then it's they're better off working with a someone they know and a local, like a local investor where they could do a joint venture, which is a lot less rigorous in terms of the requirements that the government puts on folks. It's basically like, Renee, you and I agree that we're going to buy a $500,000 apartment building. I'm going to put in, and it requires a $200,000 down payment, just to make math simple. So I'm going to put in 100 grand and you're going to put in 100 grand, and we're going to together manage that building. You're going to have certain responsibilities. I'm going to have certain responsibilities, and there's a contract that manages that whole interaction. Right. That is how a joint venture works. And that's typically how a lot of folks who are not accredited, that's how they acquire property. And then they either manage it themselves, or they have a partner who manages it, or they hire another firm to manage on their behalf.
Okay, so because you're handle 406B, can you describe, because I'm not completely familiar with how that works, but that's how your business is structured. Is that correct?
Yeah.
With the
yeah. So we have done it's 506B, and
I'm sorry.
We've done. That's okay. That's all right. It's a lot of acronyms and numbers I'm throwing at you. And I'm sure you could do the same thing if we start talking insurance, and I won't know what you're talking about. So that's okay. So the fact is that there is, so there's 506B, which is sophisticated and accredited, 506C, which is where we're moving. And the reason being is that it's a little more rigorous to determine the financial wherewithal of the partners that we're working with. But I think, from a risk management perspective, it's a lot safer, both for the investor as well as for, our company, mainly because it allows us to be more open in terms of like advertising, for instance, and talking publicly about our projects and things like that. Whereas with a 506B, I'm not allowed to talk about a project, right? I can talk about our company and what we've done and our track record. And if you as an investor want to learn more, then we can have a conversation. And then we have to actually build a documented relationship, if we don't already have one, so that if the SEC comes along and says, hey, we want to audit your 506B projects, I can show them, as the principal here, I can show them a track record of, that Renee and I have been friends for, 3 years. And here's all the emails we've shared. And here's the text messages. And here's a picture of Renee at my daughter's confirmation. And here's a picture of me at Renee's son's graduation and all that. Right. So we have to prove we're friends. Right. Okay. So it's, the other term, it's usually referred to as friends and family. Right. Okay. So we've got to be either friends or related. And I need to be able to prove it as the principal.
Okay, well, these are important distinctions, because I think a lot of people, like, I was not aware of that. And I know some people who invest in real estate, and that's not the nuance they get into. No, I appreciate you doing that. So I actually,
no problem. Yeah, I'm a little geeky when it comes to this stuff. So
that's good. I like that. But I'm kind of disappointed, because I was going to ask you about your projects. You mentioned you had several of them, and I wanted you to describe them. So now you can't. You're not... I
can talk about past projects. No, that's fine.
Okay, great.
That's fine. So typically what we work on is a term called value added. And basically I'm buying buildings that have not been managed well, either financially or physically. And the owner has decided to sell for whatever reason, right? And so deferred management, or problematic management, can be anything from not having enough reserves in the building, cash reserves to manage when stuff happens. They haven't done a good job of raising rents along with the market, and then physical issues can be things like lack of maintenance, right? Things that are broken, that have been left broken for a lot of time, run down common areas, rundown exteriors, rundown apartment units, and mechanicals like the HVAC systems, the heating and cooling, plumbing, electrical, And so what we do is we will acquire a property at a pretty good discount to the market, we will then put in, our construction crews will then go in and, first pass is clean and safe. So that means we fix all the electrical, all of the heating and cooling problems, all of the plumbing problems, things where if they really went bad, somebody could get hurt, right? So we fix all that stuff immediately. And then we upgrade the common areas, the hallways and stairs and exterior, where everybody enjoys it, so that the residents see that there's a new sheriff in town and that we're actually going to take good care of this building. And then, with regard to the units, part of our clean and safe pass is we're fixing everything in each of the apartment units. So that if you have a faucet, if a resident has a faucet that's been not working well for a long time, we'll give them a brand new faucet, and if there's damage in the apartment, we'll fix it. And, then as units come open, as people move, right, which, happens, then we'll go in and rehab the unit, where we will do brand new kitchens, brand new bathrooms, brand new flooring, paint everything, new lighting fixtures, basically new everything, right? Right. And we do that for two reasons. One is, three really. One, I like sleeping well at night, and knowing that I'm doing right by the residents that live in our buildings is one of the ways that I actually do close my eyes with a clear conscience. Two, it is the opportunity for people to, or, for us to raise the rent a little bit and make the building a little more profitable. And three, people tend to stay in a well-appointed, well-kept, well-managed building for a really long time. And that also makes our buildings more profitable, because then I don't have to pay a realtor, for instance, to lease out a new unit because somebody's already living there. So I, instead of having to do that once or twice, or once every year or two, our residents tend to stay for just short of 4 years. So that's good. So it makes our buildings a lot more profitable.
Yes. And so what is the annual return if somebody signed up today? What's an average?
So it depends on the building, because basically you're making your profits when you buy. And what I mean by that is, if we buy a building for a really fair price, then that gives us a lot of opportunity to upgrade the building, both physically as well as financially. And then, over time, as rents increase and expenses hopefully drop, the building becomes a lot more valuable, right? So you look at the stock market over the last 50 years versus the multifamily real estate, right, in particular. So depending on the source, but generally, the stock market for the last 50 years has returned somewhere in the ballpark of 7.5% year over year. Some are up, some are down, but on average about 7.5%. Multifamily as an asset class has delivered just over 9.5%. It's like 9.6. So, it's a little bit better in terms of predictable returns. I would submit that the other part of it, the reason that I am so focused on real estate is that there's no, I'm off the stock market roller coaster, right? I don't care if the Dow Jones went up or down today. What I care about is that, the buildings are being run well, and our residents are doing well, and that they're paying their bills on time. Right. Right. An entirely different model.
I know with some of the people that I know who invest in real estate, it seems to be critical that you try and catch a property that needs fixing up before it hits the MLS. So do you have a whole system or software that, or maybe bird dogs, I think they call them, to bring those properties to you?
So yes to all of those. So I come from the school of really good deals are found and created, not found in terms of off market, not found on the MLS, right? You can find deals on the MLS or the commercial equivalents of that, but it's a lot harder. And so we have people ask me, what business am I in, right? And most people will say, well, of course you're in the real estate business, and yeah, that's true, but I'm really in the marketing business, right? And so we are marketing to a handful of constituencies every day, 7 days a week, 365 days a year. And those are wholesalers. So those are the bird dogs you were talking about, right? They will find a project that meets our criteria, right? I give them what's called in my world, a buy box, which is, anything that fits in this box we'll buy. Anything outside of the box we won't buy, right? And it's things like number of units, location, potential for returns. There's about 13 different criteria we measure, and I don't have to go into those, but basically we sift those through and make sure they fit. So there's wholesalers that we market to, and what we're doing with them is we're marketing digitally. So that's text messages, emails, mostly, and social media, where we're talking about best practices and what it's like to work with us, and past projects that we've done that have worked out really well for the wholesalers. And because they make their money on the transaction as well, and we want that, right? Because if they make money and we make money, then they'll bring us more deals, right? That's the whole idea. And so we work with wholesalers, we work with brokers and agents, real estate agents, and the idea there is the pocket listings. So there are, usually there are, if you're a realtor, Renee, right, you have clients who want to sell. Some of those clients don't want to put the property on the market publicly because they don't want their residents to, get upset or concerned that, some other person's going to come in and make their life not as good as it is right now.
Right.
And so a lot of property owners will hand a realtor or broker a what's called a pocket listing, which is basically you can keep it in your back pocket. Everybody, don't broadcast it to the world. But if you have, a dozen or 24 investors, people like me, who are serious about buying properties that look like mine, you can show it to them, and hopefully one of them will buy it, right? Okay. And so that's a pocket listing. So we market to our brokers in terms of just making sure they're aware that we're out here, and we love to pay commissions, and that we can close very quickly. We're well capitalized, and here are all the projects where brokers have done very well working with us. And then the last one. So before I go there. So brokers and agents, that's also digital marketing, right? So that's emails, text messages, and I buy a whole bunch of lunches and coffee for folks that are willing to give me half an hour to an hour of their time to talk about the business, right? And then building owners is mostly direct mail. So we will do letters, postcards, basically saying, hey, save the commission. We'll buy direct from you, and here are generally the terms that we operate under. And if that's interesting to you, then let's have a conversation and see if there's a good fit. And so sometimes there is, and sometimes there isn't. So we're constantly marketing to those folks. The way that we do that is I work with, we've built a team here of really amazing virtual assistants. And so we use technology, which I can talk about in a minute, as well as our process and procedures, and the folks that live in the Philippines who do all of our social media and web and direct digital marketing and direct mail and cold calling and all that other stuff.
Wow.
And so it's amazing. Yeah, they're awesome, and I'm a huge fan of virtual assistants, especially the folks that we work with in the Philippines.
All right, yeah, I want to get to that because I think that might actually help a lot of insurance agents as well. But I want to ask you a couple of questions.
Sure, it will.
Do you work with mortgage originators and CPAs?
Yes.
Okay, and
yeah. In terms of acquisitions or in terms of running the business? Both?
Sure, both. Yeah.
Okay. So with accountants, lawyers, and mortgage brokers, originators, whatever label you want to put on them, occasionally they get deals, right? Because they have a client who either can't finance something and decides to sell, or wants to take advantage of a tax opportunity and decides to sell a property, or they're in trouble, right? They're teetering on the edge of some sort of level of bankruptcy or insolvency, and they need to sell. And so, we've cultivated relationships. In all candor, I don't do it as much as we used to do it, I probably should. So thank you for asking that question. I'm going to talk to my team about that.
Okay.
But typically what we want to do is be a problem solver for those people, for those professionals, right? And so if you have a client that's stuck, there's a pretty good chance that we can figure out some way, sometimes creatively, but some way to relieve the person who has that problem. The property owner has a problem. We can come up with a way so that they win and we win.
Okay.
And
Okay.
so, yeah, I take referrals all the time.
Excellent. Okay.
Or gladly.
Sorry, a lot of this sounds very familiar in insurance. Agents,
Sure.
managers, and carriers all tell their insurance agents to do this kind of marketing.
Right.
So, on
Right.
average, how many a day or a week do you get coming to you from all these efforts?
From leads?
Yes, leads. Yeah.
So we send, in the state of Connecticut, there are 1,208 properties that we want to buy someday, right? So we are marketing to each and every one of those once a month. So they get a letter from us, and then they get a follow-on phone call from us, either cold call or voicemail drop. So we're touching them at least twice a month, at least. On the broker and wholesaling side, we're touching them. Gosh, we probably touch them twice a month. And the folks that we really work with a lot, we touch them once a week. And in most cases, it's me calling them just to check in and see how they're doing, or to update them on a project that we're working on together or something. From a deal perspective, it's slowed up a little, quite a bit in terms of the wholesalers and brokers. Not a lot of people are selling right now. I think they're kind of waiting for they either got a really good rate, back in 2019, 2021, somewhere in there, and they're enjoying a 3 to 4% rate, and they don't want to give that up, right. Which I understand. And so, because if they sell, then they're gonna have to go buy something else most likely, and that will be at a 6, 7, 8% rate, and that's not as good. So right, so more in that case is not as good. And so they want to hold on to the property. So we see a lot of that. The ones that I'm starting to see more and more of are the folks that have what's called an adjustable rate mortgage. In other words, it reprices periodically over the course of a loan, 3, 5, 7, 10 years. And if they're coming up for that reprice, and their original rate was 4%, and now they're being quoted 7%, some of those buildings won't financially be able to operate, right? They'll run in a deficit, and that's not what we're doing here. So then it comes down to, in those cases, that's where the direct mail comes in, and we get phone calls from, or emails or text messages from building owners who are kind of staring down the barrel of that gun and have decided that they need to cut bait and sell the property. So I'd say we probably see from the wholesalers 2, maybe 3 deals a week. From brokers, we see 3 to 5 a week in the markets that we're active in. Not all of them pencil out, and then as far as building owners, I would say we probably see 3 or 4, maybe 5 a month on a good month. So it's not a ton, and that's just Connecticut. We're now expanding our business into the Carolinas and Kentucky, and we're just cranking that up now. So I don't have those numbers yet.
Okay, well, I find this very interesting because clearly you have a very clear vision of what your brand is and what you do. And I can see the correlation between an individual insurance agent and what you do. And because I'm kind
Without a doubt.
So, and I'm kind of in that space right now. I'm kind of new to insurance, but it's the whole industry sort of captured my imagination. I can see a long future for me. And so,
great.
With all your efforts, how does it come together? Like if you were sitting down, we were talking about marketing, what would be some of the things that you would say, like step by step, that you would want to see me work on to get to the point where you are?
So I think a very well-defined market and customer are really important. Marketing people talk about avatars. And so you want to know, who your customer is as best as possibly as you can, right? You want to know where they live, where they hang out, what their net worth is, what kind of cars they drive, how they spend their downtime, what they tend to do for a living, all of that. You want to know as much about them demographically as humanly possible, because the better you understand your customer, the easier it is to market to them, right? And then so I've always been taught, way back when I was taught by this gentleman, Gabe D'Annunzio, about concentric circle marketing. And so the concept is start very small, concentrate your resources, and in a well-defined market, targeting a well-defined customer, right? And so that way, the reason I know there's 1,208 buildings in the state of Connecticut is because we've researched the thousands of buildings that are out there, and we know exactly what we're looking for. And there are 1,208 of them that meet our criteria, right? And I'm not interested in anything else. And so, we market. It started off as we would market in Middlesex County, which is the county I live in. And then we would expand to adjacent counties. And then eventually we got to the point where we were marketing to the entire state of targeting those 1,208 properties. What concentric circle marketing allows you to do is focus your resources, which are typically finite, right? I mean, you only have so many marketing, dollars to spend. So it's better and more effective to spend them on a small, well-defined market and generate deals within that small market for those customers you've identified, and then using the revenue from that to grow and reach out to a little bit larger geography or demographic, or however you're segmenting your customers. And as you get more deals, grow your book a little more, right? And market a little bit bigger, right? Because the human attention span used to be, back in the 50s, was about 20 minutes. With the advent of the internet and iPhones and other similar devices, it's about 7 seconds, right? So what you have to do in order to get someone's attention as a marketer, whether you're an insurance professional or a real estate professional or someone else, you need to touch them a minimum of 7 times. And so what that means when I talk about touching, I'm talking about phone calls, I'm talking about direct mail, I'm talking about emails, text messages, speaking engagements where you're speaking in front of a local organization, the Lions or Rotary Club or whatever, doing online webinars, being out and available on social media, right? So, if I know my customers potentially are on Facebook and not LinkedIn, I'm ignoring LinkedIn and I'm going all in on Facebook, and then I'm figuring out which groups they tend to be active in, right, on Facebook. And then I become active in those, and I add value and build up a reputation and make friends. And then those friends eventually, some of them will become customers, right? And so the more you can concentrate your marketing resources, the more effective you will be. Trying to remember the gentleman's name. Charlie Munger used to talk about his Dream 100, right? And so what he would talk about is, he was in the advertising business long time ago. And what he would do is he didn't call all of the magazines that were out there that could potentially advertise, or all the customers that could potentially advertise in his magazine. He only called the top 100 customers, and he touched them and touched them and touched them and added value and created awareness. And then he eventually became friends with some of them. And then he built a level of trust with those friends, and eventually he earned the right to do business with those friends, right? Insurance works the same way. So does real estate. So do a lot of, different industries. You've got, it's a basic 4-step process. You got to make sure people know you exist. That's awareness, right? You've got to, serve them and become friends. I mean, actual friends, right? And, build relationships, because people like to do business with people they like, right? And then over the course of time, and that time can be days, weeks, months, years, you build a relationship and a level of trust so that if Renee, my new friend Renee tells me, hey, I'd like to take a look at your policies. I think you may be overpaying or you may not be managing your risk appropriately. If I trust Renee, I'll say yes. If I don't trust Renee, I'll say not yet, right? And that all that means is that Renee hasn't earned the right to my business yet, but someday she probably will because we're friends, right?
Right.
Or I'm very happy with the person that I'm already working with. And then eventually, that trust builds to the point where we earn the right to do business with each other.
Excellent.
Right?
I love
it's
that.
Simple.
Yeah, that's great information. And we're running out of time here. So just one more question. What is your favorite part of this business? What's the favorite part, your most favorite part of what you do?
Wow, that's a great question because I like a lot of it. I like the look on a resident's face when we've turned a building and it's gone from not so nice to really nice, and they can still afford to live there, and we treat them fairly and with respect. I rarely hear thank you, but you can tell that these folks appreciate the fact that we're doing right by them, and that really gets me excited.
Oh, that's excellent. I love that, Ed. Good for you. Great job. So thanks you very much. I've enjoyed speaking with you. So
likewise.
Terrific. Well, I wish you continued success, and I will let you know when this is out, and I'm happy to promote it everywhere I can.
Okay, thank you. I appreciate that.
All right, Ed.
All right. Thanks, Renee. Take care.
Right. You too. Bye-bye.
All right, be well.